Welcome to a very important pre-budget Indianomics. With the stock market down about 5% from its all-time highs and down about 4% in just 2026, first 20 days, there is some hope that the Indian government should lower long-term capital gains on equities. On the other hand, the lower capital gains on equities appears to have pulled money away from debt funds and from banks in particular, hurting debt capital and, of course, bank margins. Today, I have with me three best-in-class experts to analyze the impact of the very high difference in capital gains between equity and debt, as also the high tax on interest income. Joining me are Mr. G. Mahalingam, former Executive Director of RBI and former whole-time member of SEBI, Ananth Narayan, former banker and former whole-time member of SEBI, and Srinivasan Varadarajan, former Deputy Managing Director of Axis Bank and former Chairman of Union Bank. As I told you, expert bankers and financial experts. Gentlemen, and Mr. Mahalingam, thank you very much for joining me.
Morning.
This very important discussion. Mr. Mahalingam, let me start with you, sir, since you have been in both regulators. What, according to you, is becoming the impact of this very high capital gains tax on equity and fixed income, a very high difference?
Basically, if I have to start with a prelude, obviously the tax policy makers look at scenarios where they would like to achieve greater financialization of the savings.
Okay.
So if we view from that perspective, giving a kind of a tax dispensation which is of a higher magnitude on the equity looks justified. But then at the same time, I would like to look at the tax as something where actually a bit of a risk offset takes place, which means you are encouraging the financial savings to come into a riskier financial class, but then you are going to do a bit of a risk offset by keeping the tax slab rates a little low. In fact, I did an analysis the last about 25 years. The CAGR of the equity markets in India is close to about 12%. But the bonds have been yielding you hardly about 6 to 6.5, and the bank deposits somewhere close to that. So there is a yawning gap between the bank deposit rates and the bond yields and the equity market returns. But the equity market returns do come with a huge amount of risk. So as you rightly asked the question, I just wonder whether keeping this kind of a big differential is going to lure the retail savers as well as even some of the corporate savings would like to move into equity in search of higher returns, not caring about the risk at all. Now, this is going to be the important kind of a outcome of keeping this differential so high. So high, basically, I'm meaning that when you talk about long-term capital gains attracting a tax rate of 12.5, and the bank deposits and the bond interest rates are being charged tax at the income tax slab. Basically, it means almost about the taxation on the bond interest rate and the bank deposit income is almost twice of whatever is the tax slab applicable to the capital gains. So this is where I feel that we need to do some kind of a tweaking. I'll stop with this.
Yeah.
Maybe I'll come back in detail for the next.
Point taken. Just one point I wanted to tell you. Instead of twice the interest, my sense is it is 3 times now. LTCG on long-term equity is 12.5, whereas most people on interest income are on their slab rate, which is 33 to 42% in the case of HNIs. But Ananth, you wrote an excellent piece on how this yawning gap, and by the way, I looked at the LTCG for many countries on equity and debt, and on LTCG on equity and interest on interest income. The data will flow. The gap is the highest in India. In many countries, it is the same. LTCG is also the same. Interest income tax is also the same. What do you think is the outcome of this very high difference in capital gains?
So, Latha, let's try and look at this from the investor's perspective. Ideally, particularly at a time of greater financialization, where people are moving their savings into capital markets, what you require is people should be aware of what their risk appetite is, and they should create an asset allocation across fixed income, debt, equity, commodities, foreign exchange, and so on and so forth, real estate, which mirrors their risk appetite, right? That's the way the ideal asset allocation should happen. In India, because you have this yawning gap of how taxation occurs across different asset classes, taxation becomes a huge consideration point for your asset allocation. You're practically telling your pensioners and your retired people, if you want to see your money preserved against inflation, take more risk than your appetite actually is. Now, let's take it specifically in the case of fixed income. If, as Mr. Mahalingam said, if you're earning 6% at a time when inflation is 5%, I would argue that taxing that 6% headline at the marginal tax rate is not an income tax. It's a wealth tax without indexation.
Okay.
So, and on top of it, not only are you taking on certain amount of market risk with interest rates, etc., you're also taking on credit risk when you take on fixed income. So there is a risk component involved, there is a market risk component involved. And to that extent, to charge the entire interest at a marginal tax rate is A, it's unfair. B, it gives the wrong incentives to push people to take on more equity risk. Ideally, we should be agnostic as to asset class as far as the income tax rate is concerned. You should have the same uniform low LTCG on long-term capital gains tax on across asset classes. Then people can take an allocation across fixed income equity based on purely the risk appetite, not on tax considerations.
Yeah. I take your point. As Mr. Mahalingam said, if one asset class is giving you 12.5% and another one is giving you 6%, the market itself is directing. Why should the tax come on top and make a further differentiation? Srini, let me get the debt picture in before I ask you the equity question as well. How do you think debt capital may be hurt or may be impacted because of this very high difference? It is very easy to raise equity today in India, but will we regret that you may not get enough debt capital when you need it?
Latha, before I answer the question, let me sort of give you my thoughts on what Ananth and Mr. Mahalingam have said. I think let's invert it a bit. I fully agree with what they've said, but let's invert it a bit. I think if you look from a government perspective, I'm trying to see why exactly, because this is something which has been debated for years together and things have not changed. So if you're sitting in the government and you're basically saying the equity allocation of individuals in the country is extremely low, and India is a capital-starved economy to some extent. We are a growth economy and we need equity capital more than debt capital. And to that extent, how do I incentivize people to sort of provide more risk capital? Meaning whether we can argue whether it's right, wrong, good for the individual, bad for the individual, but you are trying to say I need more risk capital in the country because for whatever reason, our structure is this, because most of the institutions we have created are more fixed income players, not equity players. Mutual funds are just coming of age. So almost all the institutions, including LIC, including most of them, the bulk of the money goes into fixed income. Banks, bulk of the money goes into fixed income. So you need risk capital coming in, and therefore I need to sort of provide some amount of incentives for people to sort of direct their money to equities and provide, and also the allocation as of now is extremely small. Yeah. Therefore, let's sort of incentivize that. Meaning, we can, I don't want to get into value judgment, whether it's right, wrong, whether you should do it or not. But from an overall macro perspective, this is where we need the money. And therefore, let's see if I can provide that. That basically is something which I think is playing on policymakers' mind. The second is, in fixed income, 80% is institutional money. Yeah. Meaning, even FDs, if you take bank, if you look at all what's happened over the last 2-3 years, when you say bulk deposits are the fastest growing segment, CDs are the fastest growing segment in deposit base over the last few years. These are all
savvy investors.
These are all institutions. For them, capital gains, whether it's LTCG, whether nothing makes a difference because it's all business income. So the composition of institutions in terms of the overall pool of capital and fixed income is much, much higher than equities. So if you look at the trade-offs, we are looking at a small segment, which is an important segment, whose lives depend on that income, who have to be sort of protected, all that I agree. But sitting in the government, this is a small portion. So we need to see how to ring fence this and protect this. And therefore, we need to see how to sort of handle this. But overall, from a macro perspective, policymakers are stuck with this in terms of trying to say, I need risk capital. And clearly, most of the money, a lot of money in debt is institutional money rather than in retail money.
Yeah, I want your response to it. As well, my other question to you is what you argued in your pieces in Business Standard, that this very high temptation of retail money going into equities is actually resulting in net FDI outflow. We saw LG, Whirlpool, Hyundai, Prudential. Why did they go out? Because our shares in our home country is cheaper. So let me withdraw money. Can you elaborate that?
Yeah, I think the point Srini makes is valid. Except I would argue that life has changed over the last 3 decades. Okay. When we were starting off in our capital markets with FPIs and people coming into the equity markets 30 years ago, that argument of wanting to incentivize equity flows was very, very valid. Over the last few years, however, we've seen a dramatic shift where more and more people are walking into equity markets. 4 crore investors as of March 2020. Today, it's closer to 14 crore unique investors, yes. Right?
Yes.
And a lot of it, I would argue, is based on the fact that the tax-adjusted returns promised by equity markets are far in excess of the actual erosion of wealth that you see in real terms in fixed income markets, right? And to your point, in terms of actual flows coming into the capital markets seeking equity risk, the last year across, mutual funds, individuals, pension funds, insurance companies, we saw 8.8 lakh crores of flows coming in seeking equity risk at a time when the net, issuance of equity, including FPOs, etc., was just 4.6 lakh crores. So the actual flows going into capital markets right now have changed dramatically. In fact, to Srini's point, the AUM of equity in mutual funds today is significantly higher than the AUM of debt, which was not the case, let's say, 10 years ago.
Oh, absolutely.
Now, what I would argue is happening is because of these incentives, which tax is an incentive, because of which people go into equity markets, we are also seeing valuations being questioned, particularly in certain pockets. And to your point, as a result of that, we are actually seeing FDI reverse, people finding it easier to exit at significantly higher valuation for the same multinational company than they would get in their home country. We've seen cases where your price earnings in India is 6 times from the home country, right? And therefore, we are seeing a bit of a misallocation of resources going into a particular asset class in a very concentrated manner.
Okay.
I think it's important that this tax incentive at least be removed. And then, of course, Srini makes a valid point. We have to worry about lots of things together. It's not a simple univariate equation. But I would argue that the tax incentive is frankly working the wrong way right now and pushing resources for allocation to the wrong asset classes.
Okay, fair point. Mr. Mahalingam, your reaction to what they said, and more importantly, will we get into a situation where equity capital may become easy for Indian promoters actually to divest, but debt capital may become difficult? Will there be a macroeconomic problem because of that?
I definitely feel, Latha, that there's going to be a kind of a macroeconomic problem because of the imbalance that is creating right now. I think both of them very rightly mentioned about the investors moving more towards the equity, leaving even the bank deposits in the lurch. So to that extent, today what is happening is the banks are actually really looking around for the deposits. The deposit growth is becoming anemic, but the banks are having to shoulder a heavy burden of at least financing the lower rated entities. The higher rated entities can step into the bond market, can step into the equity market. But the lower rated entities, particularly the MSMEs, continue to depend upon the banks. If the bank funding is going to be in short supply, certainly the MSMEs, the production that they actually contribute to the GDP of the country is going to get seriously impacted by this, because I don't think the market funding at such a cost that the bank is going to give it to them will be available to the MSMEs, either from the bond market or from the equity market, if at all they venture actually, because not all MSMEs can venture into the equity market at all. Bond market also creates a big amount of problem as far as MSMEs are concerned. So I would say, like what the others are also echoing, I think there is a need for a very strong relook at this taxation structure right now. I'm not saying that this 12.5 will have to be taken up. I would say look at this 12.5 as a long-term stable kind of a rate, keeping this as a base. I think the rest of the taxation rates will have to be benchmarked against this rate, keeping the risk perspective in mind, keeping the policymakers' intention of developing the bond markets in mind.
Point taken, sir. Well, the more important question I want to ask you is this current account deficit at 2.5%. We thought we could manage all these years. Now it looks like the capital flows are not coming. Also, what can this budget and next budgets do? Those questions after the break.